Hello friends. Welcome to my channel, Net Charity. In the education series of charitable organizations today we will understand how charitable trusts have to make investment of funds as per section 11(5) of the Income Tax Act. So presenting before you a renowned chartered accountant Shri Ravi Gupta, who is practicing in charitable organizations from last 30 years. Let's go.
We have section 11(5) which talks about the specified modes for investing funds of the trust. Now, when you have corpus with you, when you have accumulated amount under section 11(2), these are the amounts which are to be invested as per the modes or as per section 11(5) of the Act. I'm not going through each and every item of section 11(5). You may go through it. I would like to highlight a few things. I receive many queries at the end of the financial year, that is 31st March, कि सर हमारे पास बैंक अकाउंट में पैसा पड़ा है, but we have not purchased FD or we have not invested in it. So my take, clause number 3 says that deposit in any account includes current account with a scheduled bank or a cooperative society. If you have a credit balance in the bank account also, that will be treated that as if you have complied with section 11(5) of the Act. It is not necessary that you have to take FDs or you have to invest in some government bonds or securities. Even if the money is with the scheduled bank, you have complied under section 11(5). Then section 11(5) covers immovable property also. Section 11(5) talks about depository of shares also, shares of depositories also. Then section 11(5) talks about stock certificate as defined by Sovereign Gold Bonds 2015 also. This has been introduced later on. This is a very inclusive kind of a section because every now and then there are different financial products. Those products are included in this particular section 11(5). So this is about section 11(5). Here I have covered a circular which is being issued by the Maharashtra Public Trust Act. Whoever are practicing in Maharashtra can go through this particular circular. This circular also talks about the modes of investments where we can invest. Of course, there is a lot of clarity required on this circular also, but for academic purpose, I have included this circular. The participants may go through it, and people practicing in Maharashtra, if they have any specific query related to this particular circular, they can always get in touch with me so that we can deliberate upon it. Then we come to section 11(6). If acquisition of asset has been claimed as application. Now, what does this section say? Earlier, what was happening? People were claiming the value of the asset also in the income and expenditure account as amount spent towards the objects of the trust, as well as they were claiming depreciation also. So they were taking double deduction. But now that controversy or that ambiguity has been put to rest now. Now, if you have debited the cost of the entire asset to your income and expenditure account, you will not be allowed depreciation. That means any of the two things you will be allowed. Either you debit the entire amount of the asset to the income and expenditure account or you claim depreciation. 11(7) says that either you can claim deduction under section 1023C or you can claim deduction under section 12AA or now 12AB. Earlier 12AA and now 12AB. Earlier what was happening is the people who are not having 12A were claiming deduction under section 1023C. And 1020, vice versa was happening. So that ambiguity has been put to rest by the amendments under section 11(5). Now there is one more amendment which says that whatever expenditure incurred or whatever earlier the accrued expenditure, the expenditure which are accrued to you, you have booked the expenditure but you have not paid the amount till now. Now with these amendments, what has happened is you will be allowed to treat a particular amount as application towards the objects of the trust only when the amount is actually paid, irrespective of the method of accounting that you are following. So which in other words means that suppose if I book an expense in the financial year 25-26 and I don't pay that amount in this financial year, so I will have to add back that amount in my computation. When I prepare my computation, I will have to add back that amount. And then when I actually pay that amount, I will claim that as application in that particular financial year when I'm paying the amount. So this is a very recent amendment. Of course, this will increase a lot of work as far as calculations and computations and all those things are concerned. But yes, we have to abide by it. Then
Information will be covered in part 2 of the education series. If you like the information, kindly like, share and subscribe. This will be a gratitude towards the speaker. Thank you.